Okay, first things first, how are you doing? I know that there's been a lot of market crash videos since the beginning of the year, so if you feel uneasy, unsettled, just feel free to talk to me in the comment section below. I want to spend the first few minutes calming some nerves, and then I'll talk about the two undervalued ASX stocks in an overcrowded, overvalued market, and then I'll wrap everything up with a portfolio update. As many of you know, majority of my portfolio are in equities, so I take the idea of crashes very seriously.
How serious?
Serious enough to sell my car, pull out my savings, and add more into the markets during the pandemic crash. And then during the February correction, while some people panic sold, I added another $11,000 into the markets. If you're wondering why, because despite the market pullback and crashes, Fidelity have found that over the long term, the markets have recovered and reached new heights. The key word there is long term.
Long term.
And then of course, there are pessimists that will tell you the markets will never recover to new heights, our financial system is going to break, everything's going to burn, everything's going to crash. But the thing is, if you miss out on 5 of the best trading days, then 38% of your long-term gains would disappear. But if you miss out on 50, then majority of your long-term returns will be wiped out. So the next time an economist with a 40% stock market crash prediction, ask yourself, if one of the greatest investor of our generation, Warren Buffett, does not listen to them, should you listen to them?
All of these economists with 160 IQs that spend their life studying it, can you name me one super wealthy economist that's ever made money out of securities? But if you look at the whole history of them, they don't make a lot of money buying and selling stocks, but people who buy and sell stocks listen to them, which is, I have a little trouble with that.
So what I'm trying to say here is not to completely ignore them, but please take it with a massive grain of salt. Because someone can make predictions for the last 30 years, and that prediction will eventually be true, and then they'll be screaming, I told you so. Even if there was a market crash similar to the pandemic crash last year, and let's say if it's worse, what people often forget is that the period right after tends to generate some incredible returns. So for example, post-Great Depression returns for that 5 years is 306%. And post-GFC, the market returned 178%. I think the more important question to ask is, what happens to your income if the market does crash again? That, in my opinion, is a lot more important to answer than the timing of the market crash. Personally, I'm going to stay as fully invested as possible, especially in great businesses. I'm going to continue to boost my income so that when the market inevitably crashes in the future, I'll be ready to capitalize on that opportunity. On that note, I am starting to help my Patreon start their own side hustle journey. And since it's the beginning of the month, my Patreon is free to try out. We'll talk about the markets, stocks on my watch list, and crypto. So you can try it out, see if you like it. If you don't, you can always cancel it towards the end of the month. All right, before we talk about 2 high quality businesses in the ASX, no, this video is not financial advice or recommendation to do anything. It's just general information for entertainment purposes. Now, I often don't like to talk about price to earnings ratios, but when the ASX All Ordinaries is past 55, sky high feels like an understatement. And ASX All Ordinaries is the top 500 companies in the ASX. In saying that, I don't think the PE ratio for the rest of this year will be that high because the economy is reopening and I'm anticipating the earnings to rebound. The important thing I'm trying to get at is that when the market is somewhat frothy, I am extra careful when it comes to the price I pay for the company I'm about to invest in. And the first one that I think is undervalued is
BrainChip.
I'm just kidding. Please put down your pitchforks. The first one is actually Mdex. As of recording this video, it's currently trading at $1.69 with a 660 million market capitalization and a 40 PE. Before you get mad at me for liking a company with a higher than usual PE, well, firstly, it's still lower than the All Ordinaries of 55 PE, but secondly, please hear me out. So Mdex is a mining technology company. They develop drilling optimization tools, sensors, and a data analytics platform to help mining companies with decision making. Some of the biggest mining companies like Rio Tinto, BHP, and Vale are their customers. I know that sounds boring, but I promise that the structural trends and the tailwind is not boring. When the pandemic hit last year, the global mineral exploration budget went down the drains, and Latin America was disproportionately affected just because they had a very, very long shutdown period. But since then, the economy have started to recover, and with the amount of money that's being printed, commodity prices have started to rebound like a pogo stick. At the same time, the next decade of decarbonization requires huge amount of minerals like nickel, cobalt, lithium, and graphite. And all of those materials will need to be extracted from the ground in an economical and also a sustainable way. All of these mining activities happening across the world, the S&P Global Market Intelligence is anticipating that budget will recover pretty swiftly in the next couple of years. This is a rising tide that will raise a lot of boats. And I'm personally really interested because they have a differentiated product offering, and the savings from their product is pretty obvious. Now, in a rising bond yield environment, tech companies are getting smashed left, right, and center. Trust me, I know. But guess what? Over the last 5 years, the company have grown their earnings by 37.5%. And I know that the graph doesn't really look that nice because they were impacted during the pandemic. But I personally believe they'll be a big beneficiary of the mining boom from here onwards. On top of that, analysts are expecting their earnings to grow by 26% over the next 2 years, and the expanding gross margin from 67% to 68.5% makes me blink twice. I know that they have a software platform underpinning their core business, but damn, their balance sheet is squeaky clean with short-term assets well covered as short-term liabilities. And generally speaking, it's really good already to have a balance sheet where your short-term assets cover your short-term liabilities by 2 times. But in this case, their short-term assets cover their short-term liabilities by 3 times. That essentially means that the company will have no problem handling any external shocks in the short term. With very little debt and $59 million worth of cash, the fundamentals of this business and tailwind are incredibly strong. That's why I think that this company could be a hidden gem in a very crowded and somewhat overvalued market. Just for transparency's sake, I own this company indirectly via Wax. It's on my watch list now as I think about whether I want to own this company directly. Okay, next. It might sound a little bit crazy, but Ruslan Kogan is the man. Kogan, as of recording this video, is trading at $12.47 with a 1.33 billion market capitalization. And looking at the price at $12.47, it makes me think, what the flying... The pandemic have accelerated the online retail percentage by multiple points. And that basically means that Kogan will have more customers to eventually sell to. And as more retailers come online, as long as it's a category Kogan has a hand in, they'll win a portion of price-sensitive customers. Once those customers are in the Kogan ecosystem, they will personalize a shopping experience for them and sell them a bunch of other stuff. You don't have to believe me, it's already happening. If you look at the repeat business, it seems like once people try buying things online for the first time, they'll buy online again. Looking at the second half of the 2020 financial year, you can see that the repeat order curve is increasing quite substantially. I personally have contributed to that curve because I bought my monitor, adapters, and gimbal off Kogan. On top of their growing portfolio of businesses, they have also recently acquired Mighty Ape, which is one of New Zealand's largest online retailer in entertainment. Mighty Ape will add more firepower for Kogan to add to their customer base, especially in the entertainment and computer hardware space. If we talk about numbers, it shouldn't surprise you that Kogan have grown their earnings by 54.3%, and they are a major beneficiary of the pandemic. Analysts are expecting their earnings to grow by 52% compounded annually for the next 2 years, with a tiny bit of gross margin expansion. With their balance sheet, the short-term assets cover their short-term liabilities by 1.5 times, and they basically have no debt with $78 million worth of cash. So they should have no problem dealing with any external shocks in the short term. Now, the current talk of the town is that Kogan have been sliding downhill since the beginning of this year, and many people are asking whether they have reached a bottom. To be honest, that's not really up to us to decide. A better question to ask is, given the online retail penetration, what are the future growth prospects of Kogan? I personally believe that online retail are here to stay, and it's a very fast growing segment in Australia. But Kogan are going up against some really incredible dominant players like eBay and Cash of the Day, who have caught up to Kogan in a very short span of time. I have to say, Kogan's next 12-month EV/EBITDA at 13 times is a lot more palatable than 30 times a while back. As it stands, I currently don't have any exposure to Kogan, directly or indirectly. It's just on my watch list right now as I understand the business a bit better and try to gauge whether they do have a durable competitive advantage compared to the competitors I just mentioned. Now, just a portfolio update. As I'm recording this video, my CMC market portfolio is worth about 94,000 Australian dollars. And I still have $6,000 worth of cash I need to deploy. I really don't feel that comfortable now with so much cash lying around, so I'll deploy that over the next couple of weeks and I'll keep you posted on what I do decide to do with that money. On a separate note, I'll be reducing my exposure of SPACs by quite a bit over the next couple of weeks as well, just because in a rising interest rate environment, these growth companies will probably get smashed some more. So I'm not selling because I don't believe in the company. It's just because the macro environment is not very friendly to these SPACs at the moment. And Fuse is Moneyline and Stick is BarkBox. I believe both of these companies will be worth a lot more down the track, but I'm just managing my downside risk a bit better from here. So with my stake portfolio, it's mostly US companies, and I have about 39,000 US dollars here, and that's approximately 50,000 Australian dollars. The total return have improved from last week, only because the market have rebounded by quite a bit, and March was a really painful period. And we don't really know whether the correction will continue. All I really know is that I am going to invest in high quality businesses that will do well over the long term, and I'll leave it at that. Over the last week, I did add more into Ozone and Porch only because their earnings came out and the result was fantastic. I think that they have a great growth prospect moving forward, and I'm okay with losing money in the short term in order to gain in the long term. And absolutely okay with that. I think I added a little bit more into HIMS as well. So I know it sounds crazy, but I've done a lot of homework in these companies. I feel comfortable. I am absolutely okay with my holdings. So I don't mind a little bit of loss in the short term in order to gain in the long term. Other than that, everything is exactly the same. I don't plan to sell anything in the short term, but I do have Google on my watch list as well. So thank you for watching this video all the way to the end. If you want to support the channel, not to mention access to additional content pieces and be part of my fortnightly Q&A, consider supporting the channel via Patreon. Nevertheless, if you have learned something new, remember to gently smack the like button right there, subscribe to my channel so that when I release future videos, you be the first one to know. Until next time, my name is David. Otto will always do the honors, and see you very, very soon.